Bill, Joseph, you guys ready?
Hey, yep, all
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 right.
good here.
Hey, can you hear me?
Can hear you fine. Let's just stay unmuted so we can keep it an open conversation. We'll take speaker requests a little bit later and questions. Good morning to everyone joining us for this important discussion right after Fed Chair Powell has spoken at Jackson Hole. The headlines are unmistakable, which seems to be the operative word of the day. Quote, the time has come for policy.
Hey, I don't hear anything. James, is your mic on?
Yeah, these spaces sometimes can be finicky. James, you there?
You can hear me, right, Joseph?
Okay, now I can
Yep,
hear
now
you.
you're back.
Yeah, there we go. Perfect. So just to start off, initial reactions, Joseph, you've been writing a lot about Fed policy, the transmission mechanism. I'm sure we'll talk as well about Vice President Harris's economic plans and the potential impact on inflation and the economy. What are your first reactions to Chair Powell's speech this morning?
Well, first off, I think that this was very much an official pivot. So this is much stands in contrast to what he did a couple years ago, stand up and said that we were going to raise rates, there would be some pain. But now it's very clear that Chair Powell has officially pivoted towards a rate cutting cycle and we'll have rate cuts in September, although he did not commit or comment on the pace or the extent. That's going to be data dependent. So what really stood out to me was his emphasis that now his two mandates, both inflation and unemployment, are basically in balance, with a notable mention that he does not seek or welcome further weakening in the labor market. And this stuff I think was already well priced into the markets. If you look at short-term interest rates, I think they priced in a little bit more cuts. So this should not have surprised the market at all. But of course, we do see a big reaction in equities and commodities. I'm sorry, and currencies.
Yeah, that's exactly right, Joseph. I mean, where we are right now, fully priced, obviously, for 25 basis points next month, about a 25% chance of a 50 basis point move. We've come a long way, right, Phil, from where we were at the beginning of the month, August 5th, when the market was credibly pricing a 75 basis point move with the VIX above 65. Initial read of how markets were positioned coming into this and where we stand now, Phil?
Yeah, I mean, the market had a huge reaction during the speech, after the speech. Still looks pretty strong right now. And something that I was picking up on was, I think yesterday we saw 75% chance on CME for a quarter point cut, and that's actually gone down to 67, which is like maybe a small notable move, and that means the 50 basis point odds went from, I think, like 23% to 32%. So I noticed that, and really the question I was left with was, Joseph, you mentioned this already. What is the pace going to be of these cuts? And I'm wondering, is it going to be? I assume it's going to be slower than the pace of the rate hikes. But what was your guys' read on that?
Yeah, I think to Joseph, I think it was notable, Phil, to that point, is we heard from Boston Fed President Collins as well as Philadelphia Fed President Harker. They mentioned this term these gradual easing cycle, gradual cuts, which would suggest quantitatively 25 basis points as opposed to 50 or even 75. The word gradual didn't come up in Powell's speech. I wouldn't read too much into that. The bigger date on the agenda now is September 6th. That's going to be the August employment report. We're going to see, was that big miss from the July report that triggered the sell-off and triggered real expectations of 75 earlier this month, was that a one-off? So I view the lack of gradual as Fed Chair Powell preserving optionality going into this important jobs report. Curious, Joseph, how you see it.
No, I agree as well. I think he didn't make any comment on the pace or extent of cuts because he honestly doesn't know. It's going to depend upon the upcoming jobs report a lot. I think we want to know if that sudden spike in the unemployment rate to 4.3% last month, was it some kind of aberration as people are claiming, or does it really just reflect a sudden weakness in the labor market? So a couple of things to keep in mind as we think about this, though, is that from the Fed's perspective, they think that policy is very restrictive, right? So they think that the neutral rate, maybe let's say 2-3%, or right now we're at 5.5% in nominal Fed funds. And another thing to think about is that Fed usually likes to act very slowly and methodologically. So having a sudden 50 basis point cut really wouldn't make sense usually unless you had a sudden weakening, a very unexpected weakening in the market. Now, we know that when in the past, when we were close to the zero lower bound, Fed officials would say that we should go big because we're close to the lower bound. And because we're close to the lower bound, we can't cut a lot. So when we cut, we want to be able to surprise in markets. Now we're a lot higher than we are before. So there's probably less of an impetus to have these big sudden cuts. But I agree with James. It's just all going to come down to the labor market. If it really just continues to have a surprise to the downside, higher rise in the unemployment rate, we could expect pretty big cuts. Right now, the market is pricing in 100 basis points by the end of this year. Market has a tendency, as we've seen over the past, to price in more cuts than the Fed delivers. Recall, in January, we were pricing in 7 cuts this year. So far, we've had none. So the market has that tendency. So we got to watch very closely what happens with the September jobs report.
That's exactly right, Joseph. And it's incredible. There's obviously been price volatility. That's par for the course. But it seems like the narrative volatility has been unbelievably high from where we were coming into the year. At this point in January this year, the market was saying that the Fed funds rate would be 4.5%. Obviously, the Fed funds rate is not 4.5%, it's 5.3%. And so the narratives keep changing. What was the narrative 2 weeks ago? That the Jeremy Siegels of the world wanted 75 basis point emergency rate cut. And there were some actual people behind that with how the market was pricing things. I think to Joseph's point as well is that the fact that we're so far from the zero lower bound, i.e., zero rates, that gives them some optionality to say, look, we don't have to be as aggressive. But I think that, Phil, you've written about this recently. Was this the one-off report? But I think in a more macro sense, there have been folks who have written off the rise in unemployment, saying that this has been supply driven, that this has not been the result of elevated layoffs. This has not been the result of a real genuine economic downturn. But look at what Powell says, and I'm just quoting here from this morning's speech, quote, most of that increase has come over the past 6 months, referring to the unemployment rate. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers. We know that to be immigration. That's my commentary. And a slowdown from the previous frantic pace of hiring. Even so, here's the but, the cooling in the labor market conditions is unmistakable. And I learned from my time, Phil and Joseph, in high school debate, that if you have the word but in a sentence, everything before the but is irrelevant. You're beautiful, but you're smart, but you are the head of macro, but. And so discount that, put that in context. Are we seeing that Powell really has genuinely pivoted to the employment side of the mandate, Joseph?
I think he has. And one way that I look at this is, the FOMC, the people who make the decisions at the Fed, they change over time. And so the values of the Fed, how they weigh that balance between full employment and price stability also changes over time. So One thing that I've noted when you look at the composition of the FOMC, there's been some big changes. President Biden was able to make a lot of appointments, and the people who are appointed on the FOMC now, if you look at their backgrounds, most of them, they don't really have much of a background in, say, macroeconomics, but they tend to have a background in labor economics. So that tells me that these people are going to weigh the unemployment mandate a lot more than the price stability mandate. So I think that change in the composition of the FOMC is going to structurally make it more pro-labor, and that argues for easier monetary policy. Now, the Fed, again, a lot of people, we've heard some hawks talk about what they would like to do and so forth. But I think that the tendency, though, looking across just the composition, is a more dovish Fed. And so I think it has really just shifted towards more of an emphasis on employment than price. And to be clear, if you look at the PCE data, now the Fed, there are many different measures of inflation, PPI, CPI, and so forth. The Fed cares about PCE specifically core PC, that's just a little bit above 2%. So it does make sense to care more about labor unemployment than inflation right now.
That's right.
So I have a question, Joseph. Do you think that any part of Powell's speech today, was he on purpose not mentioning the jobs revisions this week? Or do you think he was just trying to, hint at it by saying, but, what was your take there?
Well, I don't really know how they perceive the revision. Data is noisy. There are revisions all the time to GDP, to everything. He did not mention it specifically, like you noted, but he did in many ways show that the labor market was softening. And so I imagine that revision in jobs data could play into that. But I'm not in the weeds enough as to how this data actually is calculated to be able to comment intelligently on it.
And I would note to your question, Phil, that I'm just looking at the transcript from the June press conference, the one two months back. Powell says, you quote, "Well, you have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, they're still strong." And so to some extent, a lot of this was already anticipated, right? You look at the Bloomberg consensus was for a 750,000 negative revision. And so certainly the headlines have run with it. Certainly President Trump, who I think would benefit obviously from this weak data, has run with it. But this was not a real surprise for a Fed that for the past several months, including the chair, has talked about the risk that the job numbers are overstated. And even though they were overstated, they're still well above the break-even rate that would be consistent with keeping unemployment, all else equal, unchanged.
James, to your point, I would also mention that from the Fed minutes we got this week, it was noted that many people on the FOMC were thinking that maybe the unemployment data was overstated. So the employment data was overstated. So maybe unemployment rate was higher than expected. So that would imply that there were people on the Fed, many people, who were thinking that we would have a big revision like we did.
Yeah, that's right. That's right.
So how do you guys think about how this flows through to risk assets going forward? So, looks like the equity markets are loving it. Currencies, Dow's waking in a lot. Do you think this is something that will continue, or this is something that is just maybe an overreaction?
I mean, my read on this right now, the stock reaction was so immediate and so fast. It'll probably fade a teeny bit, but I think generally, if we're getting a series of rate cuts, that's exactly what markets have been expecting for a year now. I think that's, what else could it mean other than, bullish? Because this is what everyone's been wanting and expecting for so long. Finally, we're getting the signal that we're getting it. How other way would you read this?
Well, first off, I think James is having some connection difficulties, so I don't
know.
Oh,
I'm here.
Okay. Apologies. From my screen, it looks like you're okay. So, I've been wondering maybe this would be more of a sell the news event because so many people have been positioning for this rate cut cycle. And I think the truth is that we do have a slowing economy. Now, usually I would look at this at slowing economy, rate cuts, bullish, but the stock market, as we know, changes its mind from time to time. In the past, sometimes, good news is good news. Sometimes good news is bad news. It seems like we're moving into a regime where the market is becoming more concerned about recession. And so a slowing economy, I think, would outweigh the market positive impacts of rate cuts. I mean, that's kind of the sense that I got from the last jobs report, where we had a big spike in the unemployment rate, and the market didn't like that. So I'm not really sure if this is going to be as bullish as the market seems to be pricing right now.
Yeah, I think that's right, Joseph. And to Phil's point earlier, I mean, we obviously got an immediate move higher in stocks. I think it's important to look at, obviously, the differentiation, right? So to your point, Joseph, what the S&P 500 does in the wake of rate cuts and them potentially being triggered by real economic weakness is very different than what the Russell would do, as it's more cyclically focused, more sensitive to real economic conditions. The CapEx plans for folks buying NVIDIA GPUs 2-3 years down the line are unlikely to be affected by a quarter or two of negative GDP growth. But let's also not forget that the market reaction we're seeing in rates today is muted by the fact that we've already moved 50 basis points lower in the 2-year Treasury yield since the end of July. And so, I think it's kind of underwhelming, but in the sense that a lot of this move was front loaded by that weak July jobs report we got in early August. Was front loaded by the VIX going to 65, and although it's come back, the rates market is still right where it was when those moves were largely priced in. Right now, we're at 390 on the 2-year, not far from the lows we achieved in early August during that market episode. And so I think that this is not as much of a surprise since the Fed has been guiding toward it. And again, we're dealing with a data dependent Fed, guys. And so the data has been moving the market, has been moving the Fed this way. And now it was really about, I think, Powell marking to market to what the folks had already come around to seeing, which is September is the beginning. I guess the question now is, what does that pace look like, and what are the conditional probabilities there, Joseph? Is it September and then kind of a foregone conclusion for that November cut, or what are we thinking about there?
So I continue to think that we're going to have 25 basis point cuts every meeting for the remainder of this year for 75 total. But it's going to depend a lot on the job market. If we do have just ongoing deterioration in the labor market, unemployment rate continues to rise, I think we could have a lot more than even the 100 basis points priced in right now. So it's really that September jobs report is going to be really, really important, I think, in determining the trajectory of Fed cuts.
Yeah, agree completely. And Phil, any thoughts on that, on the pace?
Yeah, I think the gradual pace is going to be what we're going to see at 25 basis point cuts. My question now is really back to what you guys were mentioning about equities reacting to negative economic data. Do you think that, let's say we get a one or two worse job reports, or even if we get a spike in inflation, what's the market response there, even if the Fed continues to signal we're going to use everything in our power to ease monetary policy?
I would say, Phil, that their reaction function, which is academic speak for how the Fed reacts to economic developments, is very much skewed toward the labor market and not the inflation side. And so let's look at what Powell said in late July at the meeting, the press conference. He said, "We are data dependent, not data point dependent." Now, when I wrote earlier this month on the Azoria Substack that meant that they would largely look through the weakness and wouldn't use that to justify a 50 basis point unless it was validated by more weakness in the jobs market by, let's say, an August report that would be weak, is the same reason they would look through an inflation print that might be higher between now and the September meeting or later down the line. They have to look at the totality of it. And the totality of it is headline CPI was 9%, and today it's 2.5%, 2.6%. So we have come a long way, and we very much, to Joseph's point, are skewing toward the labor market as the primary focus of the Fed. I want to read the sentence from Powell's speech as well. Quote, let's see where it is here. It's on the downside risks here. Quote, the upside risks to inflation have diminished and the downside risks to employment have increased. And so in the event we were, to your question, to your hypothetical, Phil, to see a stronger, hotter than expected inflation number, it would be in the totality, in the context, as Vice President Harris says, the context of all of which we live, in the context of a string of weaker numbers. You would really have to see consistent, hotter, and then also the spreading out, not just isolated to certain parts of the economy, the actual diffusion of inflation to see that upend this plan. I agree with Joseph. I think we're going to get 3 cuts this year, 25 basis points, with the risk of a 50 conditional on the labor market really falling out of bed, and kind of validating and furthering that weakness that we saw in July.
One thing that's really standing out to me is the dollar, how it's been weakening significantly. When I look at the Euro USD, or especially the pound, it looks like, they're like going parabolically upwards, like the dollar's weakening significantly against them. Do you guys have any thoughts on that? It really stands out to me.
Yeah, my initial thoughts on that is that you and I and Phil know this, and I think most of the listeners know this, that G10 currency rates in particular are a function of interest rate differentials. And so it's not a coincidence that we've seen the market price over 200 basis points of rate cuts between now and the end of 2025, and the euro appreciate, the yen appreciate, the pound appreciate against that backdrop. And so in many ways, it looks like the euro and these other currencies are trading on the back of what the markets expect the Fed to do. And so then again, to throw the question back at you, Joseph, is if we don't see that Fed path as priced by the market, which is pretty dovish all the way to 2025, does that reconcile into a stronger dollar over that time period?
So when I look at the dollar, obviously interest rate differentials play a big role. But I think another thing is also that when you have a period of, let's say, economic distress, oftentimes the dollar also gets a bid as well. So even though that we're pricing a lot of cuts, I think other countries are pricing in cuts as well. If I think we've the less, of course, if the short-term interest rate path here is going to be a bit higher than market is pricing in, that's dollar positive. It also seems that the U.S. is outperforming other countries, and so I think there's a good chance that the interest rate differentials between the U.S. and other developed countries remains wide. So it's surprising to me that the dollar is getting sold so aggressively here. And part of it
I
could be
agree.
momentum as well.
I agree. Yeah, I agree. And I think that I'm curious, the stuff that you're writing about, Phil, international developments, how that might play into the currency moves we've seen.
Yeah, you mean like what geopolitics could mean for currencies?
Yeah.
Yeah, I mean, I think that's there's always a risk, of course, of geopolitics coming into play, but I think this really is a interest rate narrative here. Um, the one question I've been thinking about today is, does anything in Powell's speech to Joseph or James, either of you guys, is there any acknowledgement that the Fed has been late on cutting?
No, I don't see any of that. I
I
mean,
don't.
if they were late, they would have cut it already, right? So
Yeah. I mean, was there I don't know, I thought the jobs revision this week was sort of one data point that suggested they were late. And I wrote about that this week as well. Um, I mean, yeah, what was the Fed late? Is the Fed late still?
So I think it's important to think about this through the lens of Powell. So Powell notes that one of the reasons why there are fewer lags when it comes to monetary policy is because the market anticipates far in advance what the Fed will do. This is very different from, say, the era of Greenspan. So right now the market is anticipating a whole bunch of cuts, probably more than what the Fed would deliver. So in a sense, the Fed has already eased because rates have come down a lot. So I don't think they would think themselves as being late. In fact, I would say that maybe there's more of a chance of them having the market easing too much for them already, unless, of course, you think 100 basis points by the end of this year is the reasonable thing to do.
Right. And to Joseph's point, I mean, look at the 30-year fixed rate mortgage, right, on bank rate. At the end of July, it was 7.15%, 7.15, and now it's 6.90. So we've already seen that easing come through the market, moving consistently with the rate that 30-year mortgages are priced off of, which is the 10-year Treasury yield. You're already getting that easing. It's not as if everything is tied to the overnight Fed funds rate, right? And the second they cut, all of a sudden people start jumping up and down in the streets and start going. I think the bigger question here, before we open it up to questioning from the listeners, is what impact will this have on the real economy? Let's not forget that for all this talk about 7% and 8% mortgages earlier this year, the average homeowner in America is locked in at 3.6%. The average effective mortgage rate is 3.6%. We got retail sales blow it out of the water. We've got claims, jobless claims, suggesting that no, the labor market isn't great, but it is decent. We had second quarter GDP at 2.8. We have third quarter Atlanta Fed showing just above 2%. The market's at all-time highs. And this is against a backdrop where you have two candidates that have proposed policies, one far more inflationary than the other. And so I guess before we open it up, just last questions is, real impact on the economy. The Fed delivers the 75 basis points that we all seem to suggest is coming. What does this actually do for the real economy, Joseph?
Looking back the past couple of years, I think one thing that we should take away is that the Fed's impact on the real economy is not as strong as we all thought. Definitely have a very strong impact on financial assets, but let's rewind a couple of years. So I think a couple of years ago, everyone said that if the Fed were to hike rates to say 5.5%, we'd have a tremendous recession, unemployment rate would surge, but none of that happened. We've had interest rates pretty high, and if you look at, say, interest rate sensitive sectors like home builders, well, home builder stock still doing very well. Construction employment still doing really well. And so it seems like the takeaway is that monetary policy, that channel of transmission isn't as strong as we all thought it was. So as we move towards rate cuts, I wonder if maybe the same thing would also be the same thing on the way down. I think that as mortgage rates come down, we could see more of a stimulative effect on housing and so forth, but it's unlikely that they would come down from, to say, 5 or 4%. So maybe that impact is not going to be that large either. I think the bigger impact on the real economy, rather than focusing on financing rates, would be what happens in Congress and with the White House. And though that's going to be dependent upon what happens in November. Like you mentioned, James, we have two candidates with very different visions of how they would like to run the economy. I would think that, if you propose higher taxes and so forth, that's probably not as good for the economy as tax cuts. But, there's a lot of things involved. We're going to have to see what happens in November. I think what this tells me is that the Fed is going to be out of the picture. More emphasis should be shifted to how the election turns out.
That's right. Phil, thoughts?
Yeah, I have one follow-up question, Joseph. As far as impact on the real economy, something we've seen in the last year is rising delinquencies and corporate bankruptcies. Do you think we'll see a sort of commensurate decrease in those as rates come down? Or I guess how long does that impact typically take to be visible?
So you're right that there has been higher delinquencies, but listen, when you look across segments, when you look at what the banks are saying and a more of a historical view on, say, credit card delinquencies, you know that part of it is just normalization. In 2021, 2022, we were having very, very low delinquencies. Everyone's flush with cash, and now we're kind of going back towards how things were pre-pandemic. And similar things for bankruptcies as well. Note that if you look at market-based measures like credit spreads, they're still pretty narrow. So I think when you look at the ecosystem as a whole, there are certain segments, let's say people who borrowed at floating rates. So specifically medium and smaller businesses who borrow from banks who tend to be floating rate, they'll probably get some relief. Relief will probably be quick, but I think financing is not just one part of their problems. You have things like revenues and costs as well. I would not overplay the impact of financing costs for most businesses, because that's just, unless you're super highly levered, that's just one part of the puzzle.
That makes a lot of sense. Yeah.
And before we open it up, I'll just leave on this note. This is from the note that we wrote earlier this month. It's available at headofmacro.com, of course, always for free. It's, quote, small businesses aren't really complaining about high rates either. Just 4% of small businesses said that financing was their top business problem in June. Compare that to inflation, which is still the top business issue, with 21% of owners reporting it as the single most important problem in operating their business. And that's from the National Federation of Independent Business. And so there's a lot of focus on financing rates and all of that, but let's not forget that businesses have also borne the brunt of inflation. They too have suffered at the hands of the 25% increase in overall prices since 2021. And it's not going to be as clear cut. They're telling you just 4% are saying that, hey, financing's a problem, which is to say that lower rates coming down doesn't necessarily affect most people who are concerned at this point in time. So, all right, we'll open it up to questions for the next 15, 20 minutes. Just feel free to hit the speaker request button and for some timely questions on Fed, markets, and macro. And while we do that, and Joseph, I want to Thank you. You shared this chart that I sent out in this last note about household debt service payments. And the fascinating thing was that if we think about the amount of money that households pay to service their debt as a percentage of their disposable income, that went up in the 94 hiking cycle. It went up in the 99 hiking cycle. It went up in the '04 hiking cycle, but it didn't go up in the most recent hiking cycle. We came into this cycle where household debt service payments as a percentage of income, disposable income, were 9.8%. That's lower than the long-term average of 11, and that's unchanged with where we were today versus at the beginning. And so again, not exactly evidence, whether it's businesses or consumers, that rates are overly restrictive.
Yeah, for consumers, of course, the largest interest expense is your mortgage, and everyone locked in very low mortgages. So that could be part of the reason why the higher rates were not as restrictive as people thought. We'll see as rates come down, whether or not rates will be stimulative again.
Absolutely. All right, we're going to go to Zach first. I'm adding you as a speaker. Zach, you're on.
Hey, how's it going, guys? Thanks for sharing your thoughts on this space. I'm wondering if, relative to the Fed futures probabilities, do you think the perhaps overweight pricing on more rate cuts than would be expected by the end of next year could reflect banks and other fixed income managers preparing for an easing cycle by building rate sensitive liabilities and hedging through Fed futures? I guess I'm wondering if there's any hedging activity or positioning that might show up in the Fed futures markets as more pricing for downside rates by the end of next year. Thank you.
Yeah, that's a really good point, Zach. And it would be wholly consistent with what we've seen out of this market in the past, right? This market is not folks saying we believe that pricing is going to be here. You've got hedgers, whether they're fixed income traders, whether they're banks, whether they're insurance companies, pension companies, trading these products, not necessarily because, like Joseph and I would use them to trade some macroeconomic thesis about where the Fed's going to be, but because they actually provide a hedge. And so it's hard for us to disentangle, okay, are people buying the January 25 Fed funds futures contract because they actually believe that rates are going to be lower than they are priced today? Or are they buying that as a hedge and they're largely price insensitive because some other part of the book needs to be covered? I mean, Joseph, that's consistent with what you found, I'm sure.
Yeah, absolutely. So I think Zach makes a really good point. It's not all a bet on what the Fed will do. There's a lot of hedging involved as well. Now, if, let's say, we have disasters strike the U.S. economy or the markets or something like that, one reliable thing that you could expect is for the Fed to cut rates. And for example, in 2020, we had this big crash. The Fed cut rates to zero. If you were long silver futures there, you would have made a killing. So let's say that you want to have some kind of downside insurance for something going really bad. Well, a lot of ways to do this. You can go short. You can buy puts and so forth. One way that people do it is SOFR futures, and also SOFR futures, centrally cleared, traded. It's very liquid as well. So in that sense, it's an attractive option as a hedge.
Yeah.
Oh, that's a great question.
All right, Zach, make sense?
Yeah, absolutely. I appreciate it, guys. It seems like the forecast perhaps that might be expressed or might be interpreted from Fed futures could just be market flows from various managers. But I really appreciate it, guys.
Yeah, market flows, and also a lot of folks getting stopped out of positions. We saw that earlier this month. A lot of those prices didn't even seem real, where we were pricing the serious chance of a intermeeting rate cut at a time just because the stock market was 9% from all-time highs. What I would say, Zach, though, on the bigger point here is that when we think about trading this stuff, even though these things are the subject of price insensitive flows, folks who are buying or selling them, not because they have a macroeconomic view about what the Fed's going to do and distort the price accordingly, but ultimately these instruments settle into what the federal funds rate is during that contract month. And so even though these things can deviate substantially from what you or I think their fair value is, that as long as we hold them to maturity with some semblance of risk management, that it doesn't matter that flows distorted them very much prior to the trade, that with time the contract will converge to whatever the real Fed funds rate is. I don't mean real in inflation adjusted terms. I mean what it actually is, to what that Fed funds rate is. And so there have been opportunities. Phil and Joseph will remember this when Silicon Valley Bank blew up in the spring of last year. You had Fed funds futures pricing 3 rate cuts over a period where the Fed actually hiked rates by 50 basis points. So the market was saying we're going to cut by 75, and what actually happened ex post was the Fed hiked by 50. That was an incredible opportunity to fade the rate cuts, but you had to stay in that position. You had to have staying power, and that's where options really come into the equation.
Makes sense. I appreciate the additional insight. It's weird to think about these short-term contracts being pulled to par, I guess, but
yeah.
Thank you. That's
very
interesting.
They are, yeah. Thanks, Zach, for the question. Okay, I'm going to add Ape in paper. It's connecting. Let's see. Ape, can you hear us? While we wait for Ape, Joseph and Phil, I just wanted to point out that I think the interesting thing between macro trading products like rate futures and currencies as opposed to single name stocks is that you don't usually see the price insensitive hedging flow in single names the way you do in rate futures and currencies, right? M&A deals that push dollar yen 1 or 2 figures in a given day, or a large fixed income manager trading Fed funds futures, not because they believe the Fed's going to cut, but because they have some other risks they need to hedge. That creates really interesting macro trading opportunities for those folks who want to step in and provide liquidity.
Well,
yeah. Ape, can you hear us?
Okay. Yeah, I can hear you very well. Yes, sorry, my network was keeping unstable. Am I very audible?
Yes,
Hello?
We can hear you.
Okay, so I want to ask on a global macro level, because majority of the G10 currencies are in the rate cutting cycle, and US is about to enter a rate cutting cycle. How is all the other currencies going to play out? Because you see the currencies like the NZD and the AUD gaining strength, and they're in a rate cutting cycle. Even the GBP, the euro is in the rate cutting cycle, and they're gaining strength against the US dollar. When USD in September starts cutting rate, which we are expecting 3 rate cuts before the year runs out, how is the whole market, global market of the whole global macro of the G10 currencies, how are they going to play out against each other, since everyone is in a rate cutting cycle, excluding JPY?
That's a good question. I think that, and I'll pass it to Joseph first. I think the question was about the rate cutting cycle affecting currencies, be it Aussie, pound, euro, etc.
Yeah.
It looks like it looks like what that means is everyone is selling the dollar. Is selling the dollar in a big way. Maybe because the dollar rates are really high, and so now when they cut, they have a lot they could potentially cut. So I'll be perfectly honest, I'm surprised by how weak the dollar has become. So one of the ways that I think about this is that whereas the U.S. is cutting rates, the U.S. economy outperforms other countries, and so rates will stay relatively high. It won't go back down to zero, whereas other economies, I think, will not do as well as the U.S. And also one thing that I'll note is usually when we have, economic turmoil or political risk globally, the dollar tends to get a bid. Not really seeing that right now either. So maybe something's different, or maybe it will, maybe it will revert. But right now, Ape, you're totally right. Everyone is just looking at the dollar cutting cycle and selling the dollar.
Okay. Thank you very much.
Of course. That will be the quote of this X space, Joseph. Ape, you're totally right, quote unquote. Okay, we're gonna put that on a T-shirt. Okay, Phil.
I'll buy.
Ape,
I'll buy 10.
that'd be kind of fun, wouldn't it? We have one last question from Nemo, and then we'll do some closing thoughts. Nemo, we're gonna add you now as a speaker. You can unmute now and speak. Go ahead, Nemo. Nemo, can you hear us? All right. Well, that was enough monkey business for one space. We can't have two back-to-back apes. There was already one with the ape and then this monkey, and that's a little too much. All right, Phil. So closing thoughts. I think we're gonna look back at the speech a year or two from now and say, look, this was the pivot point, very clearly unmistakable from Powell. Closing thoughts on today's wide-ranging discussion.
Yeah, no, I think the speech confirmed, of course, we're getting a rate cut in September, but it also did not really change the near-term forecast for cuts. I don't think like something that maybe we didn't get to in today's discussion was we already knew what was coming, and Powell sort of confirmed that, and which I guess he has to do for the market. But yeah, we should see a pretty gradual pace of cuts, and that's what people expected even before today's speech.
That's right. And I think when you think about Fed cutting cycles, they kind of fall into two buckets, right? The one is, how is the Fed responding to a substantial economic shock? Think 2008, think the pandemic in early 2020. They go big, they cut aggressively, they get real close, if not hit the zero lower bound. But then you also think about smaller calibrations, 95, 98, 2019, where in all three of those examples, funny enough, they cut by 75 basis points near consecutively over the course of just a few meetings. And so the latter cutting cycles, like we saw in 2019, we call those mid-cycle adjustments, those are almost designed to bring Fed funds closer to what they view as neutral. I'm curious, Joseph, if we are definitively in one of those two buckets, or where we might lean. Is this closer to a cutting cycle where we get 200, 250 basis points of cuts? Or is this something closer to a mid-cycle adjustment? Because if we actually fully realized market pricing to the end of 2025, this would be unlike a cutting cycle we've seen over the past couple of decades. Either we typically cut from where we are, let's call it going into 08, 5.25 down to zero, or going into COVID, 1.5 down to zero, or we do a 2019 or 1998 and cut by 75. So where are you leaning in terms of what the actual extent of this cutting cycle would be?
Well, so far it looks like a mid-cycle adjustment. When we look at economic growth, continues to be above trend. When you look at unemployment rate, yes, it's rising, but it's still historically low. So far it looks like that we are not in serious danger. We could be headed there, but right now, so far, it looks like it's a mid-cycle adjustment. And I really think that going forward, when we look at the economy, it's going to be less about the Fed and much more about fiscal policy. The Fed toggles interest rates. We already saw over the past couple of years, it's not that impactful on the economy. So going forward, I think how much money we spend, what we spend it on, what taxes are, and just the overall business climate shown by Congress and the occupant of the White House is going to be more important than the Fed. So I think right now what will happen is that people, knowing that we have very different visions of the world, depending on who wins in November, are probably going to wait and see. So we could be in for a soft patch. And then what happens after November will determine what happens over the next couple of years.
Absolutely. I want to thank both Joseph Wang and Phil Rosen for joining me in this conversation. Subscribe to Phil Rosen's daily newsletter. It's Opening Bell Daily. Links in his bio. It's great. It's one of the first things that I read in the morning. And follow Joseph Wang. Subscribe at fedguy.com. He has a great market wrap every single week, a video that distills whether it's the yen, the Fed, whatever it may be that's going on that week. I use both of these resources. thanks, guys, for joining this conversation. Thank you for being a part of this as well, reacting to this annual speech from Fed Chair Powell, and of course put a plug in for what we're doing at Azoria Partners. You can subscribe at headofmacro.com to our Azoria Substack, our newsletter, where I'm not tied to the whole weekly or daily thing that Phil or Joseph's doing, but responding and thinking at a high level about what's going on in markets. Most recent piece being Markets is Weird earlier this month about how the Fed really doesn't care about financial markets moving all that much unless it has a real impact on the economy. This is James Fishback, Phil Rosen, and Joseph Wang. Thank you for coming out, taking place in the part of this conversation. We're big believers that open debate gets you closer to truth, whatever that may be at this point in time. But thanks for coming out this morning, and we'll talk to you soon.
Thanks for organizing.
Yeah, thank you.
Thanks, Phil. Thanks, Joseph.